Chapter. We'll be talking about leveraging retirement accounts to invest in Africa. And I'm glad to be joined by a few great people who have been working with us with people who are interested in investing in Africa. And tonight I have Dale Collier. He is with King's Counsel and Trust, and also James Steigert, who's also with King's Counsel and Trust. And in a moment, we will actually do introductions. But before we actually get started, I just want to outline the agenda. First, again, we'll have introductions about each one of us, and then we will be going into understanding the potential of ventures and projects. One of the things with many individual investors is that they may not really understand where ventures are in their process of development. So when they look at opportunities, it's a little bit difficult for them to figure out, okay, everything looks good, but I'm interested, but depending on what your investment strategy is, whether you want to do a project that has been gone through what we call feasibility, essentially saying this is a bankable, this is a doable project. If you want to be at that end, you don't want to necessarily be looking at projects that basically are what we call proof of concept. That's really the first stage of showing that this particular venture or project is feasible. Then we'll talk about actually using the retirement accounts to invest, and here we're really speaking about U.S. accounts. What we're talking about may apply to some other countries. You would have to investigate, though. The process is obviously going to be very similar in terms of the overall process, but depending on what rules, regulations, and how things work in your country, that may be different. But this, I believe, in part, this webinar will still be useful to you. And then we will be going through just a sample process for using self-directed IRAs to invest in ventures and projects. And then we'll have a roundup. There'll probably be things that, as speakers, that will take notes, and we just think we should, add comment. And so we'll kind of do that in the roundup. And again, one of the things about realizing about investing, not just in Africa, but anywhere, is that there is, even if you have a financial advisor, you should be involved in that investment strategy, looking at those investments and really making the decision. And so when we're talking about this particular session, I just want to iterate that we are providing information and educational information that can help you look at investments that you can apply your retirement funds to. However, we are not promoting any one organization or vehicle or anything like that. We are not providing financial advice. In fact, the way this is set up, we're really focusing on people themselves who actually will be making their decisions about their investments. And so therefore, we want to share things that are useful to them that will help them navigate that process. So we're going to start out with our introductions, and first I'm going to allow Dale Collier, who's the Director of Stewardship at King's Counsel and Trust, to just give us a brief introduction about himself and his background and what he's doing today. Dale, would you like to share a little bit about yourself?
Yeah, by all means, glad to be here, glad to be a part of what's going on and following your success. You're certainly serving a niche that's well needed long before folks come to our office, because it's a lot like playing, learning to really thrive in a calculus environment without having trigonometry and algebra and geometry, etc. But briefly about myself, my first professional career was that of a landscape architect. Doing some really big, large-scale stuff, north of $1 billion, several years, thousands of people coming to collaborate and build as teams. Wonderful experience to do anything in the world. But that's actually what led me to my second professional career. I'm still a young man, and that was to start up a broker-dealer, to move on to a very large-scale, internationally recognized wirehouse, ultimately to settle down into a boutique niche firm that specializes in alternative investments outside of the realm of securities. The ultra high net worth, if you will, have most of their assets outside of Wall Street, contrary to what you hear on the media. So the way they do things, the instruments they use, the methods they use, some of what you'll be talking about tonight in self-directed programs are, it's not new. It's just not widely recognized, not widely spoken about, educated, talked about. Nevertheless, glad to be a part here and offer any insight that we can and helping your folks understand to navigate the waters.
Great. Thank you, Dale. And I just do want to make a comment. This is one of the things that we really tried. There's a lot of mechanisms to invest in a lot of different things. And unfortunately, though, the people who have that information tend to be wealthy, and it is not generally available to the general public. And so basically that's really when we think about why we're doing this is that outside of, again, if you decide to invest in Africa or not, it is something that's useful to you so that you can really direct your own income, revenue, in this case through investment, for your own purposes. And so that's really where people should be in terms of making their decisions. And so that's again one of the key reasons why we do these webinars and information sessions. So again, thank you, Dale. James, would you like to share a little bit about your background?
Well, sure. My earliest career choice out of college was I went to work with the U.S. Treasury Department in a division called the Office of the Comptroller of the Currency. We were national bank examiners, and although that work required some understanding, of course, of accountancy, debits and credits, and how money flows into the financial statements, and our charge was to ensure the solvency and the liquidity of the national banks in which we went in and which ultimately secured the entire banking system. The work we did was more of investigative work, intuitive work, if you will, to search for and find out through the systems and the processes that were internal controls of the institution, how well they were equipped to handle aberrations, changes, secure things from making certain that there was no corruption inside the bank itself, and to basically follow the rules and the regulations, statutes and laws, the ability to cite law violations and put banks on notice.
Okay, thank you, James. I think your phone died, but I know that you'll come back. So let me just add that James now, he's the Director of Membership at King's Counsel and Trust, and he actually works with people who are, in particular, he will work with different groups, but he does works a lot with individual principals, venture or project principals, who actually are, going before investors. So he works that interface between the investor and the project principal. Hey, James, I just kind of concluded your intro.
Well, thank you so much. I can't explain it. I've had some drop calls where I'm at, and I apologize for having that happen while we're on our call today.
Well, that's all right. The interesting thing is because this is Africa, people can, this can happen. So technology is not always user friendly. But anyways, what I was just adding is that you really work with the interface between the investor and the project principals, and just making note of that you do many different things, but that's one of your areas of specialty
Right.
in terms of King's Counsel and Trust. And I just wanted to give people a note just in terms of Africa and the U.S. Treasury. Most people don't know this, that our U.S. Treasury actually does help to supply currency for banks in other countries through the Treasury Department in order to help. I don't know if it's by sector, but like for example, like small business, they
Hmm.
actually give funds to those banks to encourage them to lend locally, and then maybe guarantee. So it's just an interesting connection when you mentioned that about that being part of your background.
Hmm.
So, anyhow, so I myself, Lori Elliott, I'm chairman and CEO of AfriBiz, and we actually specialize in economic development through private sector development, and we really focus on the process of developing ventures and projects along with stakeholders in Africa and elsewhere that become bankable, and then helping through the implementation process as well. So what we do is we then look at things from an ecosystem perspective, including investors like yourself, and looking at how we can connect the dots to create a system that works for everyone. And again, as an example with this particular webinar, we have a process, that we can look at how investors can, whether they're looking at something that we have or that someone else has, in terms of a project that can be invested in. This is a process that you can use to invest in Africa. So let's just begin and take a look at understanding, how can we assess the potential of ventures and projects? And this is my piece, so I will be starting out this evening. And the first thing that I want to indicate, Jim Collins, I believe this is the writer. You have to excuse me if I don't remember correctly, but I know the name is the same. But there was a book that was called Going from Good to Great, talking about companies. And this is one of his quotes, and I think it's important to understand that. A lot of the challenges that small businesses face is that you have many people who are very innovative. They have ideas, they even have the passion, they may have the drive, they may have a lot of things. But what they don't have is a discipline around developing the venture or the project. So that means typically that there are a lot of gaps as they go through. Now, ultimately, if they come out on the end of success, they have learned to cover those gaps or compensate for those gaps. For example, many ventures in Africa, they really don't understand what it takes to attract an investor. And so what we have done is we are now adding the discipline to that process so that the ventures can ramp up and be stronger and be positioned not only for the purposes of raising capital, but also for being a sustainable venture that people would want to be a part of, including investors. So, and it's interesting because this quote says, the great task rarely achieved is to blend creativity intensity with relentless discipline so as to amplify the creativity rather than destroy it. And probably the way I think of this is if you think of energy, energy just kind of gets wasted when it's fragmented and going in many different directions and it's diffused. But when you have a laser focus, there's a lot of power in that. And so what we're saying is this discipline, this process, this methodology that we're adding to the table actually allows the creativity to be amplified and to work even better and be empowered, have more energy to succeed. So when we talk about ventures with anyone, whether it's an investor or anyone else, we really talk about venture maturation. And what does that mean? Best analogy is thinking about a child. If you have a child that's a toddler, you don't give them the keys to the car to drive the car. Okay? Now, the toddler, for example, might not know what the key is for, or a baby, let's say. What will they do? They'll chew on the keys, right? So that's first showing you that they don't understand the purpose. And Miles Monroe, a great leadership instructor, said that if we don't understand the purpose of something, we will tend to misuse it. And so with that toddler, now maybe you have a toddler who has the general idea of what it is to use the keys, and they'll put the key in the ignition. They might even turn it. I can't say that they'll actually turn it on, but there's a problem. The toddler is too small to reach the pedals. And so he still has to grow enough become more adept at, have certain physical and auditory and visual development in order to be able to drive a vehicle. Okay, and so that is an example of what it is to work with a venture or a project. When you have a very young project, when the project developer may not really understand the full purpose of the venture, if they get money, they will tend to misuse it. Now, not purposely, not in a bad, they're not doing anything bad, but oftentimes they don't have enough focus to really know where to apply that money. So that typically means that there can be greater risk because the venture doesn't really know what it's doing quite yet. Okay? And so for a lot of investors, they don't want that piece. They want the piece where you have an adult who is a responsible citizen in society, if we're thinking of that child development process, who is able to take on responsibility. And so that's what we do. We work with ventures and projects to take them through these different stages. And I really won't go through all of the stages, but you can see you start with idea, and then they go through the different, and basically we can work with ventures, all the way through. Now, again, as an investor, many of you will come in at what we call from the seed stage, where there is a proof of concept. I'll explain that a little bit more in a moment, all the way through to, a venture that is mature. But one of the problems is people tend to jump into ventures when they're actually on the decline. So you'll see something growing, but all of a sudden the industry is changing dramatically, and the venture is basically, it's not dying off, but it's basically flattening out. And I can give you a good example today with Walmart. There was just news that basically they have flatlined, and a comment was that e-commerce had overtaken the brick and mortar, and Walmart was the prime example. And they basically said they were going to be flat for 2 to 3 years. And so, of course, there was a sell-off on the stock market, for Walmart stock. Now, of course, if they reinvent themselves, they go from maturity and they go back to growth. So, so they don't have to die off. But the problem with investments often is that people come in at the wrong cycle, okay, to really get the advantage. And to be truthful, the people who typically get the biggest bang for their investment are those who come in relatively early, around the seed stage. And so that's why we see what we call a lot of venture capitalists who come in, particularly in technology. They go in at that time because they get the highest rate of return on what they invested. Now, of course, there's more risk in a general sense, but the return on investment, that ROI, tends to be better when things do succeed. So now, this kind of gets to what I was saying, gets to this. So basically, there's money needed at the very beginning, and to do some of these things, and there's a mismatch or a gap because investors tend to want to come when the value has increased and the risk has increased, and then the risk has decreased. And so, again, these are just terms that help you understand the venture side, so that when you actually look at a venture, you can ask them directly, okay, where are you? Can you show me a proof of concept that you've done some work to show that this is feasible? Can you tell me what you did? Can you show me that you've done a full feasibility or a pilot, for example? You've actually implemented this somewhere and it's working. You are now refining it in order to scale. And that just gives you a sense of helping you kind of figure out where they are and whether this is an investment you want to look at now, or maybe it's something that you want to track and determine at a later point whether you want to invest in them, or again, if you want to invest in them at all. So the process of developing a venture, and this is going to be a very good example of talking about the art of combining or blending creativity with discipline. This slide is very tight, but in the in the slides that we have allowed you to have access to, you can obviously magnify so you can see the different pieces. So I think the part that you can see very clearly here, though, is that you see a progression line from idea all the way to market launch. Now, again, you have companies that you can invest in that are already existing, they're already in the market, and and they're in their startup growth or maturity phase, and in some cases, some of them are dying off. And so this really just focuses on the newer ventures because that's a really hard area for people to kind of figure out, whether you would want to, you as an individual would want to invest in that. So what we're trying to do is educate you about that process so you understand it better. And then on the other end, what we're doing is we're working with developers in Africa to ensure that they're going through the proper process so that when they say that they have a proof of concept, which is essentially saying that they've pretty much proven that there's a product that a certain type of customer will want to buy. Okay, and so that's more of a proof of concept. It's generally very small in scale. Then they will go to a pilot where they'll implement based on that prescribed or created model. And then once they've got a pilot on the ground, which they may not call it a pilot, they might just call it a soft launch. It's a small launch in a few locations in order to build some momentum. And along the way, there are many steps. And so below that progression line, you'll see different what we call modules or steps that they go through. And so in this model that we have, there are actually 48 steps. Now below that, there is a lot of complexity. Part of the problem about working with ventures in general, new ventures that are in this process, is that they don't understand all of the pieces. So what we've done is we've looked at how to develop a methodology to put all of the key pieces in quite a lot of detail to help them navigate themselves through the process. Now, for you as an investor, how does this impact you? It's actually very positively, because one of the things that we do is when we are working with the developers and also working with key stakeholders, we may have banks and other investors that have larger funds, for example, and they want to invest, but they need ventures and projects to invest in Africa. And so what we actually do is we help them expand their venture project pipeline by helping more venture and project developers get to at least the proof of concept stage. And so what that does is that means that there's not only the developer involved, but there's a full ecosystem, both in Africa and outside of Africa, that's supporting the ventures to go through. And as you learn to invest, when you see that there's strong linkages with major partners, for example, they might have a partnership with Microsoft, they might have a partnership with GE, that speaks volume about the potential of that particular project or venture, because they have very strategic and significant partners. We also, that ecosystem also allows us to have more transparency and also accountability. And when you have an ecosystem in Africa, things are again very fragmented. Some countries, they don't have very strong institutions. So when you're looking at how to reduce risk, one of the ways is having the local ecosystem working with the developer, and and basically, I forgot what they call it, but it moderates the likelihood that someone would do something that is not conducive to that ecosystem. So for example, running away with the money, and other stuff. And this is not a problem just in Africa. It's just an example. Okay. So then there's compliance, due diligence that's built in, not in the formal sense of paperwork, although we do cover that, but due diligence in just knowing your customer. And I think Dale can probably give just a little bit of a snippet on what that means when we hear that, from an investment or financial perspective. And I'll have him open up his session and just, mention what that means. And so basically, there are reviews. So what you know from this process is that the venture has been rigorously put through a process that is detailed, that is friendly or speaks the language or works in a way that banks look at investment or large-scale investors. Okay. Now, of course, this never means that there's not risk in a project or venture, and that it won't fail. Okay, you can never actually guarantee that. But what you can do is know that from the different things and the different institutions and the different mechanisms that the venture is working with, that that venture, the idea looks good, but the venture itself has also gone through a process of a development, and they're at a certain stage. So and they've demonstrated how they've already used the resources that they had. And so for you as an investor, you can be then can begin to look at, for what type of venture would work for you, and if a specific one is of interest to you. Okay, and so I won't go into details in terms of the actual program, but this again kind of gives you an idea of what it looks like for a venture who's trying to attract investors like yourself. Okay, so what we've done and what we will give to you also as a download is that the tools that we use with the um, venture developers and the project developers are also useful to you because they allow you to ask the right type of questions. So we have them listed here. I'm not going to go through all of the different elements, but I just want to say that all of them help you to ask the right type of questions about that venture or project that you might be considering investing in. And so they're, in a sense, they are self-educating. They help educate you as well at the same time. So basically what they do for you is, excuse me, not for you, but for the venture developer and project developer, is that they learn to develop their idea in the process that works for investors and funders. And with all of these different tools, and obviously there are more, but these are the main ones that we'll give to you to investigate, you'll see that there's a lot of detail to help them, do what needs to be done in order to be properly matured the venture so that they can access investment. And then on the flip side, it's the same tool that you can use to investigate. So this is really my piece. I am going to hand off to Dale, and he's going to talk about using retirement account funds to actually invest. And Dale, just before we get started with this, can you just explain a little bit about what it means to do the getting to know you process that's required, by the financial industry, and how that is an example of how investors should also, particularly those that are, directing their own investments, how that is, really a process that they should be doing as well, at least at some level.
Yeah, happy to. That knife cuts both ways, interestingly enough, as much as the entrepreneur should get ready to receive the frequently asked questions of the investor. It's become more commonplace now to actually do due diligence on the investor, and I think so. There's an equal responsibility because beneath the surface, there's a global financial accounting task force compliance act that's in place, whereby the United States, largely because of their banking rules and how they work with the Federal Reserve and other countries, really require certain disclosures for transparency and mostly to prevent, terrorism. So this is anti-money laundering and other type of counterterrorism measures to be able to trace the money. So without getting into a lot of detail, may I suggest, anyone that's listening, if you don't know what those things are, go to Wikipedia, both the Know Your Customer or KYC rules and/or also anti-money laundering (AML) rules for global compliance and banking and financial affairs will tell you more than what you need to know about how to get ready to interview your entrepreneur, but also as an entrepreneur, also how to interview your investor, because like it or not, I mean, a real example is mega churches in
Entry and
America
exit chimes are off.
are one of the most significant sources of money laundering for certain, I'll just say, multi-letter agencies and non-governmental organizations with which to infuse money back into the economy. And nobody talks about this stuff. So money comes with a spirit, and we owe it to ourselves for both sides of the equation to check out just what's behind the money and to make sure there's compatibility. That is really the objective. In the name of consumer protection, it goes both ways. So great point for bringing that up, Lori.
Okay, great. So, so actually, before I, and you don't have to mute yourself again, Dale, but I just want to give a story about why, if you read the description of this webinar, I made the comment, or Afrobus, we made the comment that, if you have your money in a 401k or, regular IRA, you're probably making maybe around 1%, but more than likely less. And so after a period of time, 5 years, 10 years, you're actually, even if there's not inflation, and the US currency is strong and all of those things, you're still actually losing money because the cost of living goes up. And things, begin to cost more, food and things like that. And so you find after the end of 10 years that you basically don't have, you're losing money. And we have a real story here. I have a colleague who called me, when I announced this webinar, actually, and we were having a conversation, and she said she admitted that she had gone to a bank and asked them, about investing in something, or basically getting a better return on her the money that she had deposited, and they put her money. It was $5,000, and they told her to put it into a CD, and that CD was getting a rate of 1%. So she went back. I don't know if she actually started looking at this after like 2.5 years. And after 2.5 years, she only made $80 on that 5,000. And she was very upset. So, imagine yourself that you have this money sitting that is there because maybe you worked, or maybe you set extra money aside for your retirement that may be, 5, 10, 20 years away, but you necessarily haven't been looking at it very closely, or considered maybe the balance isn't, like really, you know, uh, going lower, but you haven't really considered how the cost of living, for example, has been increasing. And, comparing, do you really have enough, in order, for your retirement, or, whatever else. And so that money is sitting basically, and you can actually do more with it, and you have a lot of flexibility in that, actually. And so when we talk about the basics of retirement accounts, Dale, I want you to um, go ahead and start with this conversation. But the idea is that if you have money that's sitting and it's not earning money, it's actually losing money. That's just not a proper use of your money. You want to leverage it so that you have that you can achieve your life goals, whether it's a living standard, whether you decide when you retire that you want to do something else, start another business. You want to maximize what you are setting aside for that period of time in your life. So Dale, would you like to go ahead and just give us some of the basics of retirement accounts?
Basics, yeah. It's a great place to start. And so in general, there's probably, I'll just say depending on how you want to slice them and dice them, there's maybe 8 or so different plans that come to mind. You've got your traditional qualified plans. These are profit sharing, 401k plans, company sponsored plans, qualified meaning pre-tax. There's more individual plans that are traditional IRAs, which are also pre-tax, Roth IRAs, which are post-tax or non-qualified, self-employed plans, SEP IRAs, which are small business or individual group plans. simple IRAs. There's similar in the not-for-profit world of a qualified plan is a 403B account. You've often maybe or even heard in educational accounts of a 529 plan and the education savings account. In general, all of these refer back to a segment of the tax code. And if your advisor isn't up on what I'll just say ERISA, employee retirement type accounts, find someone who is. That may mean having an additional legal or accountant type, on your professional team to kind of get the broadest comprehensive overview of what's going on, because not all plans are created the same. What I didn't mention is the most lucrative of plans, where you have to take the most responsibility, but given today's environment and how restrictive some of these other so-called canned plans, cookie cutter plans really are, the self-directed plan's really the only way to go. And I'll tell you why. Because if you're not doing about 20% a year, you are going backwards. And you won't be able to retire, much like more than 95% of them so-called Americans sold on the American dream will not be able to retire. And so my point is this: it has nothing to do with your risk tolerance or your financial plan, because if it doesn't allow you to cross the finish line, you don't finish, you don't retire. And so, without getting into the nuances, let me just set the stage that if you don't know about the self-directed, we'll talk about some of those specifics tonight. But definitely at this point, pause, write it down, go find out about it. At the end of this presentation, I'm sure that Lori has a few suggestions of a few national trust providers. We use a few of them, or recommend a few ourselves, that can help you really learn all there is to know about it and take responsibility for your future and your family and your legacy. This is not a function of outsourcing to someone else who basically has little or no clue other than how to read a bunch of few charts and make a nice sales presentation. You're going to learn about business. You're going to learn about some great assessments and questions to answer, even if you've never considered it before. There's an app for that in all of this self-directed process. So let me stop there. Back to you, Lori. Are we getting off on the right foot?
No. Yes, definitely. And I just wanted to add, we've done a couple of other webinars around this, and for different audiences. And one of the things that we were talking about is when your employer actually chooses the plan for you and sets it up, or where the investments go. And Dale, I want you to be unmuted for this because I want you to comment that many of those decisions are made by human resource managers who know nothing about investments. Dale, will you just comment on that?
Yeah, one of the first questions to find out what kind of a plan do you really have is it sold through a brokerage environment or is it sold through an insurance environment? And if you have an insurance-based plan, which is designed to mirror a brokerage-based plan, 9 times out of 10, you're going to find that, number one, there's more moving parts, which makes them more expensive. The reason they're more expensive is because there's a life insurance component handled above and beyond typically the core investment that is designed to mirror the exchange traded fund or the mutual funds or what have you. But when it comes to selecting what options there are, chances are it's the management at the HR level that makes these decisions. And I can assure you, they're just being presented what they're being sold in terms of package. You've got your short-term plan, maybe your mid-term plan, and your long-term plan. You've got your fancy name of, Fidelity this and Sequoia that and growth this and income that. But HR people don't go to school to understand the nuances and more or less how to tell one from another. And it's like a lot picking a horse in a horse race, and unless you really know what you're doing, Um, it's a crapshoot, unfortunately. Now, am I saying they're bad? No, not at all. There's this company matching that is often quite lucrative. That if you're not participating in at least what the company will match dollar for dollar, then I'll say you're missing out, because all of that's free stuff. That's free money in terms of on a pre-tax basis, insofar as your stock participation is concerned. But the other thing to also inquire is that if you do find out that it is an insurance-based plan, you may want to have a more closer look from a third party. My point is there could be a conflict of interest, and in which case there are lawsuits against these things. And the reason why there's lawsuits against these things and why they are insurance-based plans is because, unfortunately, the business owners, they're human, and they want what's good and best for them. And so, if in order to get the safe harbor of getting these really lucrative business owner like insurance policies, deferred compensation plans, and so on and so forth, they by default have to also offer certain types of plans. And that can be dangerous, and it can be a conflict of interest, and it's certainly worth looking into, because I can assure you there isn't an HR person on this planet that is versed in the literacy of both the technical and the fundamental analysis of choosing one fund, let alone an entire plan for their individuals. And also, by the way, they're not supposed to give advice over which types of things that the employees can participate in or not. They have a thing called open enrollment, and it's basically get in a chute, and what you pick is what you get for the next period. And that's no way to manage your retirement.
Okay. So, so then that leads us into what is the state of retirement accounts in the USA. So this is, I'm just going to open this up because I was reading a article that said that the retirement accounts, there's $23 trillion in some form of retirement accounts. 7.1% of that, I believe, are in 401ks. And basically that probably means that, again, they are making only, very low percentage. 2% would be high. And Dale, I just wanted to add, it was interesting when you were talking about the 20%. I was trying to be moderate, saying at least 5% or 6%, but, definitely there's a big difference between 1% and 2% and 20%, if you want to see, have what you need when you retire. And so that says
Lori,
to me,
that's a big reason why most of your wealthy people don't have all their money in Wall Street. Because if you look at what the return on invested assets or return on capital, it's a very specific metric on every publicly traded company. Very few companies, and I'm talking the blue chips, the stuff, the big boys that have been around a while, very few companies get more than 20% on their money. And so my point is simply this: if I can do better with your money, net expenses, than you can do with your money, why isn't someone else managing your money? That's dude. Maybe there's a vanity issue there or a pride issue, and oftentimes that is the case. We have to help folks work through that. But I got to tell you, there's the wealthy people know that the only way to really do above and beyond what the market is doing, because let's face it, the market was designed for liquidity. It was designed to sell off the investments that the really wealthy people maybe didn't want anymore. And because it's no longer about raising money very quickly to expand very quickly, but it's more of a liquidity event. And so they're dumping all of the what used to be good stuff, but it has a diminishing return. They dump it off on the middle class. And the middle class thinks they're getting a deal. And Google's going public, and Microsoft's going public. But I assure you, all of the millionaires that happened in Microsoft and Google, they were millionaires before they went public. And so
yep.
the wealthy people know that the real deals are in what's referred to as private equity. Private equity does comprise venture capital. It does comprise angel investing. It does comprise, not-for-profits. In fact, not-for-profits, mergers and acquisitions, is 5 times that you'll find in the for-profit world. But nobody really talks about it. So there's a lot going on in the private equity space. The big issue is there's no standardization of terms, of due diligence, of reporting and transparency and governance and all of those other things that public companies have to subscribe to. To be a public company, just the cost of administration will run you anywhere from $100,000 to $250,000 a year before there's any returns to the shareholders. And so the person that really gets hurt the most, unfortunately, again, is the little guy, because what he used to make in terms of returns, thanks to Sarbanes-Oxley and other type of legislative acts, all in the name of consumer protection. Don't get me wrong. They're doing their job, but they come at a cost. And it's coming right out of your pocket as an investor. And again, as a rule of thumb, if you're not north of 20% a year, I would say go fishing in a different pond, because the fish that you're fishing for just aren't there, and you might starve in the process, or your family might.
And I think, one of the things, so when we look now at to Africa, because we talked a lot about the retirement accounts and just the general process. So why do we now match this, and align this with Africa? It's basically the last frontier market in the world, and it is very easy even in more mature markets in Africa to find opportunities that will give you, that 20% return year on year. But navigating that can be quite complex. And so that's obviously what we're doing on that side to help, make that better and make it easier, make it more streamlined. And so the idea with this particular webinar is to say, okay, if there are systems in place and things happening in Africa, then how do investors, and particularly, a lot of you listening to this are, probably people who are of faith, Muslim or Christian. You might be African American, you might be African diaspora, you might be someone who's just passionate about helping in Africa, and you think investing in maybe social enterprises is a great way of doing that, and you just don't know mechanisms of how you can do that. And one of the things that I like about investing versus donating is you have a choice. You can certainly, reinvest in, for example, that social enterprise. You can take part of that money back to do another investment or to do other things with it, build your own retirement, but at the same time, put money into what we call as a social enterprise, but it's impact investing, something that's going to make a significant difference in health, education, socioeconomic issues. And so with Africa, there's a lot of that opportunity in many different things that you might want to invest in, because when you think of Africa, and again, we're not focusing tonight on all of the statistics, just on the mechanism for how you connect, to those opportunities and how you can invest in that. And basically, Africa right now is like what the U.S. was in the 1800s, particularly the late 1800s with the expansion to the west. And, there was the need to build railroads, towns, cities, and all of that. And that's what Africa is today. So there's huge opportunity. And most of those ventures who are developed well, again, they get high returns. And so 20% is, I won't say it's normal, but it is, it's a typical number, something that can be achieved. Okay, and so when we talk about this investment, it's really to say, listen, how can you, as a middle class, and that could mean you're making, whatever, 50,000 upward of, we know, 500,000. I mean, the middle class is really quite, expansive, whether you're up or lower. How can you do that? Now, for some of you, you might have to pool your money with other people in order to do that, so that you can have a good minimum investment to make an investment in some way. Again, not necessarily in Africa, but elsewhere, and that's okay. But the idea here is just to say, okay, what are some alternative investment opportunities besides what my company offers, besides what I see through a financial advisor, besides the stock market? Okay, and this is where we now get to the alternative assets. What we're talking about here is a mechanism that is a part of alternative assets. So Dale, can you explain what it means, what we mean by alternative assets, or what the industry means by alternative assets?
Good question. By Wall Street's definition, they would suggest that it's not anything that is not a security and it doesn't widely trade on the open exchange, over the counter, as they say. Real estate, for example, can be both a real property asset, but because of the nature of it is a securitized piece of real property, it has a twist. When you invest internationally, let's say you were buying Sony, or you were buying a foreign emerging growth country opportunity, an ETF, for example, for Brazil or South America as a continent, all of those would be considered alternative assets. But how we define them is quite simply the difference between what is simply paper and what is real and that you can touch. And so we're referring to that as real property. Cash used to actually be redeemable for something real. Anymore, it's what's referred to as a derivative. So when we're talking about alternative asset investing, we're talking about investing in something real. You can go touch it, kick it, taste it, smell it, get involved, volunteer with it, grab a shovel and dig with it. But you can enjoy so much more return on the investment of so-called your financial investment in some other type of participatory, results-based, collaborative-based, innovative way, what we'll collectively call strategic philanthropy. Because, in my opinion, it's all about philanthropy. It's not about what you make in this world that anyone remembers you by. It's what you do with it in your life, and it's how you impact others to the degree that you're considered to be significant in the lives of others. And so it's interesting how it all kind of ends up back into this philanthropy. What's the money for? Have a plan when it comes to alternative investments, because as Lori first shared with you early on, this is just a seed. When's the best time to plant a shade tree? It was 20 years ago. The next best time is today. And so what type of shade tree, what is the spacing on that? Because for every acorn, there's 1,000 oak trees. Are you willing to stick it out and enjoy the harvest? When that oak tree begins to bear fruit? I hope so. So it takes a little bit, again, with alternative assets, a little bit longer time horizon, patient capital, as they say. This is not the hare race per se. This is more running the race of the turtle. And this is sticking around. So I would also encourage everyone in the alternative space to have a passion for what you're really interested in, because a wine collection is considered to be an alternative asset class. So also are antique cars and furniture, even clothing and jewels for museum artifacts. We've looked at monetizing so many different forms, but bottom line is love what you do, so that the money doesn't become the primary thing or the only thing that you focus on. And I assure you, and it may just be the best hobby you ever get enjoyed with, and you may not even call it investing it anymore.
So Dale, let me just make a couple of comments to that. So one of the things is, I think what's great about this is that when we think of the African diaspora, many are very passionate about Africa. They want to see it develop. They want to see the communities develop. So what I really like about what we're talking about is that it really just allows you to live that dream, to be a part of building a new continent that is flourishing, prosperous, and enabling you to choose projects that are local to your country or local to your state or the city where your family came from in Africa. And I think really what I'm finding, particularly among young professionals, those under 40 or under 45 that are African diasporans, that they really already have this passion and they're trying to figure out. In fact, there are many that I'm seeing increased numbers who want to go back to Africa, whether they were born in the United States or, born in Africa, and they want to do something. And so I think this is a great way for those who, for whatever life circumstances are, you can't go back to Africa at this time, or you can't do some things, you can actually begin to do this. And this is actually, and I'm saying this from a personal note, this is much better than government bonds, okay? Because are used by the government to build infrastructure. Okay, and that's important. So I'm not saying don't do it, but if that's something that you decide that you do, they call them diaspora bonds, really. That's what they're calling them. And so they raise bonds, and they target the diaspora in order to help build infrastructure. And to be truthful, you can do that, and they're in debt to you, and they have to repay that money. So basically, you're actually you're helping to put your country, your home country, into debt, and those debts get very high. And if those bonds are in British sterling pound or in the US dollar, if you look at the currency rate right now, the exchange rate, what they have to do to repay that, in some cases, let me just give you an example with South Africa. When I first came back to the United States after I had lived in South Africa for a long time, the exchange rate was 6 rands to the dollar. It is now close to 14. So if they had instituted a debt based on 6 rands to the dollar, they are actually paying double now because of the currency differences. So what we are more about is how to build ways where we all share, we invest, not create the debt, invest to help this done, and then we share in the reward. Okay, so that's one comment that I wanted to make. A second comment is related to the patient capital. That's why the retirement accounts are really great, because if you're going to really see the fruit of your any type of investment in Africa, you really need to be patient. A minimum of 7 years is my thing, although you can get returns before that, more than definitely, but 7 to 10 years. And so for many people, if you're investing cash that you have on hand and you have buckets, for example, you want to keep a slush fund or whatever, that may not be patient capital. Okay, and so, but retirement accounts, it's there unless you're going to retire in the next 2 or 3 years. Basically, you have patient capital that's already there that's not being, multiplied. And so this really allows you, just this, what we're talking about, there are so many objectives that you can achieve in your life and make a significant difference for your family, your direct family, for your country, your home country, and also build your own wealth at the same time. So that, to me, that's why I'm really passionate about this topic tonight, because I just think that if it's already sitting there and you're not using it, okay, and you need to do more with it, you can look at projects in Africa, and now we're showing you a mechanism by which you can do that. And so really what we're talking about, this really isn't new, by the way. Again, it's just that it's not been shared with what I call the vast majority of American citizens. So so Dale, it looks like you want to make a comment now that I've added to what you
You feel me. You're absolutely right. If you're 50 and under right now, and you have more than 6 months, I'll just say, safety capital set aside, I would say, what are you doing? Do you know what you're doing? Because the opportunity at hand is, if you could invest in Europe as one of its original founders, and the United States, and China, and India. You take the G7 and you combine that, all of these land masses fit inside the opportunity that is to find the continent of Africa. And so your challenge is going to be, is the opportunity there? It's going to be, which one? You're a kid that just went to Disney World for the first time. You're going to find that if you like ice cream, this is better than Baskin Robbins. This is Baskin Robbins times 1,000. It's what flavor, what topping, how do you like it in a cone, in a shake, in a you're going to have a more difficult time to figuring out what you want than identifying the opportunity. The opportunity is there. No one has a very wide interest in selling it right now because it's largely unknown. But therein lies your opportunity. Because I would say, look around. What have you done in the last 10 years? If you're not growing double digits, if you're not going beyond the 20% mark, as I suggested, shift. Now's a great time to consider something different. And Africa, we love it because of the many opportunities that it holds. That you're definitely not going to get bored. Definitely go over, see what's going on, and be a part of a generational wealth and legacy building for your family. That's pretty exciting. How you could be remembered as a granddad from your kids' kids. If you've got a better opportunity, take it. But if not, this is definitely warrants a closer look. Back to you, Lori.
Thanks, Dale. So now, James, I just wanted to note, because we're almost done with this topic, but I just wanted to know if you had anything to add, because I've had you on mute. So, are there any comments you want to make or add to this, to the conversation?
Well, sure. Am I off mute? Am I clear now?
Yes, you're clear. Yes.
Okay, good. Well, I want to apologize to some folks on the phone. If my call line drops, I so much apologize because this is a topic that's so near and dear to me. I just love the way the conversation is going. So let me just roll. And if the line drops, my apologies. It's what's important here, and I hope you get out of this, is take an active role. Dale made a comment. If you have savings that can last for you more than an emergency opportunity for 6 months or more, that should be deployed and used. But don't just arbitrarily allow it to be used by the guidance of others. Take a personal active role, just like taking a personal education role for yourself, for whatever your opportunity is for you, whatever your vocation is, whatever your lifestyle circumstances are. You take an active role because there are lots of mechanisms to take someone else's funds and put them into deployment. Again, Dale made mention of there's all kinds of opportunities out there. But the active role you should take is in an area or an arena to which you know something about. Make sure that you know what you're investing in. Make sure that if you're taking that personal choice and a self-directed way of doing things, and there are mechanisms, if you have a fund already existing, you can roll it over and get yourself into a self-directed one, and therefore you can make your decisions. But when we use the topic of patient capital, guess where the patience is? It's on both sides, not just where it's deployed and how long it might be sitting there, but the patience also comes in what decisions to make before they deploy it. They're not just a knee-jerk reaction, this is a great opportunity, I just want to be so much in and I want to go ahead and let it roll. Take your time, do your homework, do your research, invest in something that you know, and then Dale made comments of 20% return or something like that. Actually, that isn't particularly hard if what you invest in is something you know, is something that you've done your homework and your research on, and it's something that's taking advantage of great growth. Growth should be measured not in percentage, but in multiples. If an opportunity comes to your awareness that is likely to grow by doubling or tripling or quadrupling in a matter of a few years, and you understand the mechanics as to why that's likely to take place, you understand the management involved, you understand what their market positioning is and what their unique proposition is. If you understand some of those particulars, and you take your time and you really research what you do, getting a multiple in a return or a 20% return for an investor's side is not uncommon. But it takes perseverance, the education, the dedication to it, and recognizing that you should take an active role. If that's not the way you want to do things, then be extremely cautious about where it is you're deploying your funds otherwise to ensure that someone that you feel very comfortable with, and I just don't mean because they have a grand brand name or they are recognized on a national or international scale, but because you have some reason to get a relationship with that organization, that institution, and that environment, so that you know what their value systems are, what their core morals are, and what they're doing in order to ensure that they really have you as not just a customer, but that you understand each other in terms of where your goal setting is. And you should have short-term, intermediate, and long-term goals. And depending, again, upon your age, Dale mentioned of a person, if you're under 40 something, well, maybe if you're older than that, maybe you're 50, or maybe you're 60, or maybe you're 70, or maybe you're just 20. Depending upon where you position yourself and the degree to which you're going to educate yourself and understand what your use of funds will be into the marketplace, it's a grand strategy to build wealth for reasons of doing good works and doing other things to help an economy, to help a country, to help a circumstance, something you have an affinity toward. But it takes some discipline. And at the very least, think of it as personal choice discipline. So that's my comment, Lori. But I'm glad my phone stayed alive this long.
Yeah, and thank you for those comments. One of the things that I think what you're saying is really quite important, and really it is definitely your own decision. You have to make the change and want to do this. We're very big. I think all of us, I can speak for all of us, that if you're going to succeed in life, whether it's investment or anything else, you are taking the lead in doing it. And you have to take the responsibility, you have to take the risk associated with making decisions, but do your research, do those things, and at least if you don't do it, if something doesn't work out for you, it was your decision and you don't regret, doing something that was tied to your destiny, to your passion, to your purpose, whatever it is. So I think that's very important in investment. It really isn't about the money. And the other point I wanted to make, what Jim was speaking about when he was talking about the multiplier effect, doubling. That's why venture capitalists get in at the seed stage. Because if it's a good business model and they know it's growing in 5 years where the industry is going, they will double their investment, the value of their investment. And so that's another thing that you have to consider is, yes, you can invest in a mature company organization that's going to a new market. That's a great idea. But you may, as you get more comfortable in understanding how all of this works, you may want to then look at investing in the earlier cycles, because of where you're really going to get the multiplier effect is when you're in that seed state, startup and growth stage. Okay, now of course there's more risk, but again, there are ways to mitigate risk, that happens because the company wasn't structured correctly and all those different things. And so those are things that you investigate, because everything is risk. Business is risk. No guarantee. Disruptive, especially today, we have disruptive technologies. One day something can be very viable. The next year it's out of the picture because a new technology came along. So those are things that just naturally happen. But of course, if you're doing your research, hopefully you're following those things. And if it's an area that you're an expert at, you then really, you know what I'm saying? Excuse me. You then tend to generally know that those things are happening. So it's not about investing in something because it can make money. It's connecting it with who you are and where your strengths are and your passion are. Dale, I think you wanted to say.
Yeah, one more point on the self-directed nature, that this asset class as an alternative asset the way to mitigate risk, I don't think of there as being risk. I think of them, I look at proactive as responsibility. When you take responsibility, you overcome risk. When you're fear-based, that can cloud your decision-making process, and unfortunately, that's dangerous. It's hard to predict fear, what you'll do. I would rather work from a position of strength, if you will, number one. Secondly, your options in the self-directed world. Let me just throw out a few. Let's face it. Do you know anything about equity, debt, preferred debt, structured finance? May I suggest that who said it has to be equity or debt? Did you ever consider that there could be something else? Equity-like returns are attractive, but it doesn't mean you have to have equity. Fixed income returns doesn't mean that you have to have debt in exchange for interest. So if current income is important, again, take a step back, assess what's important to you. Are tax considerations important? Did you know in the alternative investment world that some of these things are maybe tax deductible? If you investments are not tax deductible. So again, come back to your motivation. Are you looking for the upside? You may be looking for a tax deduction to offset earned income somewhere else. So again, the complexity of these things, yes, it's not as simple as a binary option of yes or no. You have options. It's not an either or. It could be an end. And maybe that's important to you. I would further go on to say that this is the only space that we've been able to find that you can actually custom design based on your economies of scale or your breakpoints, let's say, that if you wanted to have principal protection options, for example, those two are possible. What does that mean? Well, in a case of making a traditional investment, if the investment goes south, you could lose your money. Well, with a principal protection option, let's say the underlying option is backed by a particular bond scenario, or somebody's got a gold mine that they'd like to put up a few claims for in the event something goes south, or maybe there's an old oil well. You get the idea. I'm going to put up my car. Well, in America, most people know it as a home equity line of credit. Aha. That's interesting. You're telling me I can use another asset. I can bundle it with this other opportunity. And I'm saying, yes, you can. It really takes people to think outside of the box and be looking to create value. The ones that create value in this world will never be lacking of work. They will never be faced with poverty, and the rest of the world will be coming to knock on their door and give their money in exchange for the value that they create. Those are the innovators and the big winners of this next economy. And you can be a part of that. If you've got any type of creativity in terms of, status quo just isn't working, I would encourage you, take a look at Africa. Take a look at some of these self-direction options, and try not to limit yourself in any way, shape, or form. The blue sky truly is the limit here. Back to you guys.
Yeah, and so Dale, when we're talking about that, I think one of the great comments is, and I just want to contextualize this. So when we talk about principal protection as an example, basically like on a project in Africa, and again, this doesn't just apply to the African market. If you want to do South America, these things also apply. But basically, you oftentimes, even to get the other types of finance, like structured finance, project finance, these are like for very long-term projects that are huge, like energy plants, dams, oil pipelines, that type of thing. There has to be a means of securitizing or collateralizing those projects, okay? Because the debt financiers don't want, they want everything to protect the money that they give. They want to get it back, obviously with interest, but they at least want to be able to get what they put back in. And so it's somewhat similar, for you as a person. You have that option as well when you work in these types of mechanisms where you can, and there's a premium to it. You have to pay an amount to a firm that does that. And if the project meets their approval, for example, they will then, basically say if something happens with that project and it fails, your principal amount that you put in, actually then you get back. Okay, so that's what Dale was trying to provide as an example. You cannot get that with the stock market. Okay, it goes up, it goes down every day, and things are pretty crazy right now. So, and so people are fearful. So there are other channels that you can use and different ways to, even if you don't go to the route of the principal protection, where there is some shared risk and shared reward. So you learn how to diversify, you learn how to, package your investment strategy so that you get the maximum benefit, but also not necessarily putting yourself, up against a wall, in a bad situation. So, again, many of these things, we're going to have more webinars concerning this because basically it's a whole new realm for people. But tonight we just wanted to focus on, the very simple concept of using self-directed IRAs and using those to then invest in those funds into alternative assets. And in this case, of course, we're specifically looking at venture and project opportunities on the continent of Africa. So Dale, I think Jim mentioned just the idea of, how the transfer happens, between a self-directed IRA, or maybe it was you. Sometimes I lose track of things. But can you just talk now about leveraging the retirement accounts for investing in alternative assets? I think, we've obviously been talking around things, but just can you just give a 2 or 3 sentence summary of what we mean by that? Dale, can you unmute yourself? Oh, there you go.
My
Perfect.
mistake. Yes, I'm sorry. A couple steps after you've done your homework, you're dissatisfied, you'd like to take steps. As we close out, I think, Lori, you have a few different service providers. They should be national. In terms of having a footprint, you also want to check with your local broker dealer because candidly, they may not offer this as an option. You're going to need to have identified, number one, a custodian that will, without conflicts of interest, selling you a bunch of stuff because it's illegal as a custodian to recommend anything. The nature of self-directed is just that. You take the responsibility for the direction. It's up to your trustee to act on your behalf. Number one. So find that custodian that can cater to the types of investments. They're not the same. They do similar things, but unlike broker dealers, they all have their subtle nuances. So, relationship is important. But assuming that you've gone that far and you found that type of custodian, first thing you're going to do is to open an account. It's a self-directed account based on your retirement plan, and be it as an individual, post-tax, pre-tax, qualified plan for retirement, what have you. The self-directed plan will allow you to have this general account. And it's only then that you have that account that you can basically go back to your employer, go back to your rollover situation from a previous employer, go back to any other accounts that you may have. You may have to set up more than one. However, now that you've got this one or more buckets with which to be able to now pour into, you go back and again, they can execute the transfer forms on your behalf, assuming that you've passed the know your customer, anti-money laundering, and so on and so forth trials, investigation that you will have to do when you're setting up your own accounts. But now they will execute the transfers on your behalf, and now you're in charge. You haven't invested in anything yet. All you've done is, number one, you've identified the most appropriate vehicle. Number two, you've begun the paperwork with which to acquire the vehicle. And number three, you've just put gas in the vehicle. Where Lori and the AfroBiz group are basically going to tie these two together is now you've got to develop a navigation plan. And your navigation plan now is your map. Where are you going to go with those funds? How many stops are you going to make? What are you going to see along the way? All of those things. This is as much as you get into vacation planning. In my opinion, this is a whole lot more fun. But that's when this gets really interesting. This does not have to happen in a sequential timeline per se, as much as this can all be going on in parallel. Our firm, can provide some guidance, as can Lori's. We cannot make the decisions for you, but we can certainly tell you what's a good deal or a not so good deal. But Is that kind of what you were thinking, Lori, in terms of practical steps someone can take to kind of get started?
Yeah, and I think it kind of overlaps also what James is going to do, but I think people will want to hear it more than once anyways. Um, but I think one of the things that when I think of this, when we talk about navigating, um, one of the things that if you're going to make an investment, obviously you're going to do your research. And so what we mean by helping you, we are not. So for example, we will, like I said, we have a platform. That through which many ventures and projects will come through. What we are trying to do is systematize how they go through the process, to help them do it better, creating that venture, but also then reporting to you about that organization. So that's really our role. But what we have though is we have mechanisms for you, like tools and different things, so you can investigate those things much better than you can now. And I think that's really what we're talking about in terms we have the app, as Dale likes to say for it, to help you do that. And so, the different, even the tools that we'll give you for download will help you do that.
Oh
Now,
my goodness,
Dale, and
yes. Well, I'll just
in
say this.
fact,
If you've never known what questions to ask to a prospective charity, a church, a ministry, a corporation, somewhere in between, there's more than 1,000 questions that we've already thought of. So that based on your selection process, your area of interest, there's so much to choose from. It would be irresponsible on our part to just kind of throw all that out at you at the same time. This is really that custom where you get to pick and choose, and as a first timer, it's a wonderful experience.
yeah. And I'd also suggest, James, and you can make a comment. This might also lead to the idea because you like to deal with the people in the process. We all do, but I think you have a special focus on that. But I really also encourage you to do this in a group. You don't necessarily have to do the investment in a group, but really, work with each other to learn, to share what you're researching, what you're learning, and work together over a period of time. That's one of the things that we'll be instituting. We'll probably be able to do it as an online format and an offline format, or basically we haven't really quite decided, over a 6-month or a 12-month period, we will introduce different topics, and it's like navigating, okay, you have money, you want to do something with it, and then month by month, we literally, give you steps and tools that you can do this so that you're prepared to make those investments. Again, not giving you the advice, but giving you a means to navigate that process. And so, so I think that is really, for most of you, I hope you're excited about this, to know that there is this opportunity, and there are many things that you can do with just this one mechanism. And, of course, we'll do other webinars talking about other mechanisms that we're tied to. But, but really, this is just, to me, it's such a simple, it's complex in the sense because there are many parts, and you need to learn some of those different things, but it's very simple. And, you find a venture or project that you like, it looks good, feels right, you've done your research and all that stuff, and you're passionate about it, and then you now have a mechanism that you can do that. And so that's why I think that this is such an empowering thing, because most people really don't understand this. But
Just imagine if you could, everybody maybe have heard of Shark Tank. Lori, what you're doing here is just imagine everybody on as a panelist in Shark Tank. What you're hosting here is folks to be a chance to be on your lion safari. Yeah, that just sounds like so much fun to me. I'll stop now.
you know, you're doing something, but you're fun along the way. So it's, and this is the other thing, is this is something that you can share with others and share with your children. So you can help. This can be something that, just like what wealthy people like to do, whether it's always successful or not, because we have, different young children, or I'm saying children that don't meet the aspirations or potential of the previous generation. But you're able to leave a legacy and see wealth built within your own family, by showing new mechanisms and ways, and showing your children, how they can invest, how they can, grow what they have. And so these are things, they talk about financial literacy, but I think there has to be investment or multiplier, um, you know, uh, literacy and proficiency, not just for the very wealthy, but for everyone. James, I'm sure you want to make a comment around the people thing. So, and probably
Well,
more.
well, thank you. Yes, it's really about building an attractive, what we might say is a wealth building program or a legacy building program. We can do this, and it can be done with a variety of opportunities, including what we call charitable giving, right? And even charitable giving can actually end up being a focused attention of use of funds that can be deployed into a condition or marketplace or an activity that has a heartfelt desired reason for why someone wants to promote that activity. There can be returns, there can be wealth created, and it can be used to re-give or to ensure the solvency and the liquidity of a project. And whether it's a long-term project or a short-term project, building up a kingdom of treasury for yourself and then being able to use that for your own generational activities is just phenomenal. But it does require knowledge, and it requires that if you set your focus on your knowledge, this knowledge will set you free forever. And it becomes some basic rules and some basic principles that turn out to be a skill set. And you, just like at playing tennis or any other sport, it takes a little practice to get good at it. But you don't have to worry about how hard you're going to practice if you have the rule book and the coach nearby. And so we simply say there are better ways than to just simply sit back and let the market conditions carry you in a direction that oftentimes drifts you away from what you need to create for yourself. With a little bit of proactive activity, the right rule books to review and understand, a individual can self-direct their decision-making process is how to best utilize that available resources that they may have at their disposal now or at a future date. And again, every individual is going to be uniquely different. Everything from their background, their experience, their amount of value added that they can provide. There may be activities that you want to be involved in that you actually are involved in, rather than just deploying funds into them for what we call investment or return reasons. So Dale had said it earlier, there's a lot of, there are some particulars, I should say, not a lot, there's just some particulars that people have to walk through in order to do things correctly. And then once those funds are available to themselves to utilize, then there's a new experience that often people have to gain some familiarity with as to how to go ahead and most prudently and properly reuse those funds. And they're available to you. Resources are there. And as Dale kind of started off in the first part of the hour, it's the kind of thing that the very wealthy utilize all the time. And most of the time, their funds are not necessarily in what we'd say the equity markets or the exchanges as far as ownership of mutual funds or stock portfolios or so forth. So just encourage people to seek the knowledge. It's available to you. We'll help where we can. So back to you, Lori.
Sounds great. And so I think, and actually this is probably all three of us should comment on this, but this then talks about the King's Council and Trust model. And I just, from our purposes, what we're looking at is we call them new asset formations from a and this is where the structure basically of where your investment goes into. Okay? And why I'm bringing it up here is not so much to get into the details, but what I like about it is it allows everyone to use their strengths. So for example, everyone comes in, they bring their piece. There will be the financial investor or contributor. But then in our case, when we are developing new ventures, we often work with people who have talents and time to contribute. So when we work, for example, with software developers on our platform, they actually get a share for what they put in. It's not cash, but it's a cash equivalent in our mind, okay? Because if we didn't, if we didn't set it up this way, we would be paying them cash. And so what happens then is, again, I think really for the African diaspora or even people of faith who are trying to do specific types of projects, and you want to be a part of something, if you don't have as much money to invest, but you do have time and talent, you can participate in it. And then, get a share in the reward because you have made a in quote unquote investment or contribution. And so I think that one of the things we've been saying is that your investment of whatever type, time, talent, or treasure, your cash, your whatever, should be around your purpose, around your passion, something that you know something about. And so you either can do that again with your cash, your assets, because even some assets like equipment and other things could be contributed, not just time and talent. Could be land, could be a lot of different things. And so what we love about this is it just allows basically everyone to participate in their strengths, whatever it is. Obviously it depends on the project, but it really allows people to find something and work within a structure that allows them to, align with who they are, where they want to go. And it's very difficult to do that. I won't say it's impossible with the stock market. So, anyways, so Dale and James, do you want to make comments about that?
You spoke to the upside. I'll speak to the downside. The bottom line is, unless you're what's referred to as an accredited investor in this country, a qualified investor in this country meaning the United States, an exempt investor in some way, it's illegal for you to participate in private placements and along the lines of this private equity type situation. And my question is, why is it illegal? They put this consumer protection in place basically because the little guy can't make up his mind, doesn't know the right questions to ask, doesn't have the right team, doesn't know about due diligence. My point is, in a self-directed environment, you are taking responsibility to say, as an exemption, I am taking responsibility. And so there's the shift. If you continue to do it in the regulatory realm, you waive your rights. But as a self-directed person, you are reclaiming your natural right to direct your time and your talents and your assets wherever you deem them appropriate. You are protected under the First Amendment, and you get to syndicate any type of a contractual arrangement that you'd like to do. That's part of what King's Counsel and Trust helps folks do is work through the legalities and the compliance, if you will. But that's enough about the downside. It's really worth a closer look to think about what the upside is for a change. James, how about you?
And I was just going to say that's not really a downside. That's just a reality. It's,
True.
it's just a reality. But James, go ahead. I'm sure you have a comment too.
Yeah, we really believe that, in the world of taking care of yourself, wherever there's personal choice, and most particularly in this world of what we might be calling legacy building, ladies and gentlemen doing business with ladies and gentlemen, and understanding the relationship between your own um, centered alignment for where you want to be and what you want to accomplish, and having, in essence, maybe a personal statement for what you want to accomplish for yourself, and a bit of a vision statement, just like a business would create for themselves, wherein you're creating what do you want to accomplish in the years to come, and what do you need to ensure are principally accomplished in the years to come. Dale spoke momentarily about the downside risk. Well, certainly it's there. But with good, prudent planning, we can reduce that, or the individual can reduce that, and ensure that they are most properly being cared for in their own decision-making process. And it's about choices to which we make. You know, in accountability, we are responsible for the choices that we make, and it's the impact that those choices make on our life energy and who we are and what we accomplish that will set us the difference in the years to come. So I think the whole package here is all about don't coast and don't allow yourself to meander. A little bit of self-direction in your decision-making process and a little bit of education for yourself will go a long way. A 5 or 10 or 15% improvement in that arena can yield you 100, 200, or 300% improvement at the far end. And of course, that's what we're looking at, is where does this all take us?
And I just want to add that for me, freedom is very important. So as Americans, I think most of us understand the concept. We may not really be living free, but we understand the concept and we value that freedom. And so basically, when you allow someone else to make those decisions for you, you are actually relinquishing your own personal choice. You made a personal choice to have someone else do that. And if you're not actively involved, you're basically delegating that to someone else. So not that you can take that back in that scenario and, be self-directed, but basically, we've, the people who really make the money, honestly, are those who make decisions for themselves and make personal choices, and have direction and have purpose. And so, if you're satisfied with what your employer is providing, or whatever, then obviously this is not going to be a path for you. But at some point, more than likely, you will have to begin to make decisions that related to investing, where you take a more active role. Because what we see in today's economies is things are just very turbulent. They change. One thing looks very good one day, and I don't mean like on a singular individual investment, but I'm just talking about, with our industry, we see so many shifts, so many changes. And so what may seem good today, 10 years, may not be. And if you're just coasting along, you kind of miss that, and you end up getting stuck in the middle of all of that, instead of, being proactive and watching and looking and researching and fully participating. So again, the self-directed IRA approach, this may not appeal to you. But I do believe, as someone from the African diaspora, I'm African American, so I loosely consider myself part of the African diaspora. But in that, I know that the hope of the continent is not in institutions. Institutions are important, but they support people and they support ecosystems of people. It's the people that will make the difference. And so for yourself, for your family, wherever you're going to be located, I really believe that this is a mechanism that will help you build a future for your family and for the broader communities in Africa. So I just wanted to next, we really probably already talked about the sample process, but again, it's just going to clarify. James, this is really your section, so I'm sorry we kind of just overlapped, but I will just, really restate this, and then James, you can take the lead and make any comments if you want to, and then Dale, you might have some closing comments, and then we're going to just do a quick roundup. So one, Dale and Jim, we talked about, you want to find a self-directed IRA provider and open an account. We have, at the end of the presentation, we do have a list of some that you can investigate and look at. Once you've got that, then you start researching, and then ultimately you choose an investment. And then you will work with your self-directed IRA provider, filling out forms and all that type of stuff to transfer funds into the self-directed IRA. And actually 2 and 3 probably is switched or working at the same time. And then ultimately when you are ready to make that investment, then you will submit paperwork to have the provider transfer the funds to the investment, the venture or the project. And it doesn't matter where the project is. It can be in Africa, you can be in the United States, and you can transfer to that. So, there's a lot of freedom. Obviously, we still, you're not without any regulation. You still have, like Dale was talking about, money laundering. So everyone's got to make sure they know where the money came from and all of that. But basically, there's a lot of the burden of regulation of trying to invest. If you are self-directed, you are exercising your freedom that is guaranteed, like Dale spoke of under the First Amendment, to make your decisions, whether good or bad. And that's just a simple explanation. So James, do you want to add comments to just this summary of the process for doing this? James, can you hear me? Okay. It looks like he's still
I'm
online.
sorry,
But, okay.
I was
That's
on
all right.
mute. My
No
apologies. Well, starting at the top of the list, of course, choosing a IRA provider or self-directed investment provider where you're going to migrate funds from where they may be currently at to a self-directed program. There are several, and I say start right off at the beginning. Research those organizations that do that. There will be fees associated for handling that account. However, they're usually quite minimal. They're just fiduciary responsibilities, but look at the history and look at the experience of the provider. And then you're going to take that opportunity to begin your process to say, well, where am I going to redeploy these? What choices will I be making down the road? So that's an initial ongoing activity. Transferring your funds to the IRA, that's just a mechanical process, again, using paperwork, signatures. It's usually not too long in its time process. That can be a week or 10 days. And then submit the paperwork to the provider. When you find the investment you're looking at, understand thoroughly that investment. When I say ladies and gentlemen, doing business with ladies and gentlemen, the big print giveth, the small print taketh away. Look at the agreement and understand the details of any investment that you would make. Understand from the moment that they're deployed, what they're going to be used for, how they're going to be used, if there's a return opportunity as to how much that return is predicted to be. There's no guarantees, or there should be no guarantees. In fact, if you run into something that offers you a guarantee, unless it's an insurance provided mechanism that's bought and paid for, and you know what the underwriter of that insurance policy is, that's about the only limits of guarantee that any investment can provide any longer. Even government guarantees are a little suspect these days. So be careful, understand what you're going to do. The prudence is the key. Take your time, be meticulous, understand the particulars, understand the long-term effect, and when you make those transfers, understand what instrument you are going to get in return and the mechanics of that deployment. There are, if you are from the United States and if you are in a certain state, you may have certain rights when it comes to a statutory activity. And so understanding the particulars, the depth and breadth of what that is, and an advisor should be able to advise you on those particular things when you're looking at a particular investment itself. The persons that have created that investment opportunity should have thorough and complete information, ask lots of questions, any question that's unanswerable at the time in which you ask it, get your answer. So deploying of the funds to be used in a project, source and use will need to be understood, and then what you are expecting in the term of outcome for your investment. And then, of course, some principles would obviously apply. Don't put all your eggs in one basket. Make sure you're well diversified. Look at a few things. Again, I spoke earlier, invest in something you know, even though it may be a single activity. Rules of engagement usually are, don't try to get up to bat and hit a grand slam home run. By putting all of your opportunity on the line, so to speak, and say this is all or nothing. Not a very prudent way to do business for yourself, and really not a very good way to create legacy opportunities. You can always enrich an opportunity along the way. So small bites of the apple are usually recommended, but take your time, look at the paperwork, understand what it is you're entering into, and again, take that personal self-responsibility, and I think you'll find that this is how, we know this is how wealth and legacy building is really created. So hopefully I hit that well. Perfect. For you.
Yeah, perfect. Dale, I think you want to say something?
Just one footnote to James' explanation there. I cannot stress enough that step 4 here about submitting your paperwork, this is new language. It is literally like Chinese to some people. The greatest difficulty we have found is learning the terminology of one word mashed together with another word that individually you know what that means, but when they come together, you got to understand, unfortunately, the regulatory community has made this appear to be really difficult, that you need an MBA or a doctorate degree to get through this stuff, that you sign enough papers. If you've bought or sold a house lately, you know there's a forest of trees. I mean, it's ridiculous. But we cannot stress enough that it's prudent to take the time to get to know the language, because the language of capital is just that. It has its own language. And what we're encouraging you here, what we're really saying in terms of us as helpers, mentors, coaches, supporters, directors, is to help you learn a new language. That you, after we put the training wheels on and teach you how to ride this bike, that we get to pull the training wheels off, go do it again, but you get to do it again for you and your family and your kids and your kids' kids and so on. They just don't teach this stuff. That's why we're here. That's what we're doing in the world at the moment. And we hope that you really get it. The rest is up to you.
Let me just add to James' comments. So when we were talking about the cycle, one of the things that I always tell people is that you don't have to jump into it, meaning you don't have to commit huge sums of money or any money to start, because it's going to take you time to feel comfortable with the process, like Dale was talking about with the language. And so, give yourself a goal of a year that you are going to prepare yourself and do what you need to do. You may not decide to use by the way, this process, it doesn't have to be retirement funds. You can also use self-directed IRA with any form of legal legal cash or anything that's liquid. Maybe even some other options Dale probably can add to that. So if you want to put in other money that you have that's sitting, or you're going to get money from something, an inheritance or whatever, you can do this. It's not just for retirement accounts. That's just a source of cash that we're specifically talking about, but there are many different sources, that a person typically has. And so, then look at doing things. And again, I'm encouraging communities of faith and African diaspora to work together to learn this process. You don't all have to invest together, but I think, locally, or in your state, there will be professionals who can help you understand this language. They may not know specifically what Dale, James, and I have spoken of specifically around, this mechanism of plugging into ventures and projects in Africa, but they will understand the language and things like that. And, you need to learn those things. So, set reasonable targets for every month to learn and to do your research so you're prepared to invest, and then also set aside money every month that you're going to say, okay, I want to invest 10,000 by the end of the year, and so every month I'll put 1,000 away. Okay, so another thing is if you have retirement savings, you may decide, okay, I'm only going to work with 10 or 15% of this to start until I learn what I'm doing. You don't have to put all of your retirement into this. You don't have to take that huge step unless you feel like, again, it's self-directed. The whole point is you make your own decision. But there are ways to gain, get yourself proficient and at this process and what's going on so you can make better decisions. So it's the same thing, it's kind of like the child development. You're also developing as an investor. And so when you first start, you don't, just take the resources that you have when you're a baby and put them into something that you don't understand, you don't know how it works, you can't read the language. But you can just like put things in trust for when you mature enough and you have a better sense of what's going on, you can then, make some investments. And as you learn, you can do more. And so it's not about a race, it's patient capital. That also means you should be patient with yourself and making these decisions. And then, at some point you will, if you decide this is your route, you'll have to take the leap, but you're not leaping without being prepared for, having to work with this process. So that's what we just really want to encourage. So I think that's the end. Just for the roundup, are there any final comments? That I don't have any comments because I've been commenting all night. So James or Dale, do you have final comments for our group here tonight?
Only funny comment I would have, Lori, is number one, thank you for having us on. Um, Hopefully we've done enough of a job to open up a can of worms here that warrants, just saying, look, why bother even putting them back in the can? Let's look at something else. If we've done that tonight, then we've done our job well, and I look forward to going into much greater detail in any subsequent other types of these webinar type formats you'd like to do, perhaps a live panel, radio, what have you. I think it's important to invite people's questions as a part of this. There's no cookie cutter answer. Everybody's individual circumstance is going to be different. So to have things so cut and dry, that's just not the way of this self-directed world. It's really as unique as the individual, and that's the way we like to have it. We treat everybody as family per se. It's not about the money. But it doesn't mean that we can't make a good living in the process. And so we look forward to the next opportunity. We can serve you, your group, your clients, and have some fun together. James, how about you, buddy?
Well, I think that's it. I think this becomes a joy. We're looking at the opportunity to become a live, active participant in your future. So many people, unfortunately, regard their investments or their set-offs to the side and don't look forward to their own future, in that they are proactively depicting it and saying they can get it, an active role. It's not hard. And earlier tonight, Dale, I know you said it because you'll say it often. This can be fun. This can really be a activity that people can enjoy, saying, not only am I doing some good things, I'm directing my funds to a project that you, again, may have an affinity toward, or something that is just simply needed, and you want to see and have a personal drive and desire, compelled to move forward in some way, but then do it in a way that's responsible, and do it in a way in which it becomes, the outcome doesn't serve people if the outcome is not successful. The beauty of my experience in the background, when we talked about backgrounds to get started, was my understanding of solvency and liquidity. Sustainability is where we're really talking about. And with any project, we're talking about an early stage, in some cases a pre-revenue development stage. Then we're talking about a project that goes into revenue, and then we're talking about a project that may go all the way out to, and needs to go all the way out to a maturity, a sustainability stage. And when we're doing that, if you can align yourself personally for yourself and for your family, or for your significant relationships with other people, that you feel that this is a compelling need for you, by all means, do it. Self-directed just means that. It means take a hold of your future and be able to move forward.
Well, thank you, James and Dale. I always have fun when I talk with you guys. So,
thank you.
So just closing out tonight, I just want to provide contact information. I know this is a new paradigm for many of you, so you'll probably listen to the recording more than once, but you'll still have questions, obviously, because we're just beginning to unpack different ways of multiplying the wealth that you have. And again, we'll talk about different forms and how you can connect that with Africa. But in closing, I just want you to know the last slide is actually the websites for the self-directed IRA providers. These are some of the top ones in the United States. And again, you investigate which one or others that might be most suitable to you. So that's it for tonight. Dale and James, any last comments before we sign off?
I just simply want to say thank you again to you, Lori, and recognize that if anyone's watching or listening to this webinar, please listen to it more than once if this is new for you. Getting acclimating, getting your feet wet in this world isn't hard. It just takes a little bit. Dale talked about sometimes the language that's involved, and understanding that language again is not hard. It's just new for you. So, welcome you. And thank you, Lori.
Great. Dale, you have a closing comment?
All good here. Just pleasure to be here. Thank you again, Lori. Enjoyed it.
Okay. Well, that's it. And we thank you all for joining us, and we hope that you have a great future in store for you. Bye now.